Recently, China's largest real estate developers, Evergrande Group and Country Garden, have consecutively defaulted on their debts. Following suit, the largest private asset management company investing in real estate, Zhongzhi Group, also faced a financial crisis. Country Garden's owner, Guoqiang, had to sell his private jet to pay off debts, while Evergrande's owner, Jiayin, was taken away by the police for investigation, and executives from Zhongzhi Group were arrested. On August 25th, the State Council of the People's Republic of China passed the Guoqiang Opinions on Planning and Construction of Affordable Housing, claiming to launch a new round of housing reforms. The aim is to alleviate the anxiety of middle-income groups about not being able to afford commercial housing by increasing the construction and supply of affordable housing and promoting a new model of real estate industry transformation and development. This move is widely regarded as a significant signal from the Beijing authorities. Shanghai housing prices plummet by 51%. In Shanghai's Yangpu district, the Miyun Community was valued at 133,000 yuan per square meter in 2020. Now, prices have dropped to 64,000 yuan per square meter, a 51% decline. With such a sharp drop in Shanghai, would you still dare to invest in real estate?
I bought a house in this neighborhood. I purchased it on September 10th, 2020 on Teachers' Day, when the sales office had a promotion. The interest rate was 6.37%, with a 30-year loan of 1.12 million yuan, so my monthly mortgage is 7,200 yuan. The interest is even more expensive than the loan itself. I really regret it now, and I never thought my life would turn out this way. I've cut back on going out to eat and socializing with friends, and in general cut back on going out. To save money, I stopped buying clothes and makeup, and we don't take our child to expensive amusement places. Over these 2 years, we've really cut back. My husband is even losing his hair. He's stopped socializing, stopped smoking and drinking, which I suppose is a good thing. He's anxious all the time and can only sleep 4 to 5 hours a night. I suggested he see a traditional Chinese medicine doctor, but we can't afford it, and sometimes he even experiences chest tightness and shortness of breath. This March, my husband lost his job, and in April, I did too. When it rains, it pours. This is my husband. He just came back from a job interview wearing a suit. The job pays 4,000 yuan a month, with only 1 day off a week and mandatory overtime on Saturdays, plus 2 hours of overtime every night. He used to make over 10,000 yuan a month, but last October the company cut salaries and staff, and he barely made it to this March. After the new year, the boss couldn't keep going, and the company closed. The main problem is that we lost our income and can't afford the house anymore. We paid a down payment of 280,000 yuan with a loan of 1.12 million. Part of the down payment came from my in-laws and parents, plus what we saved from working over the years. Now, not only has the house price dropped, but we also have a 30-year loan that we've only paid for 3 years, and we've lost confidence in being able to continue paying it.
Looking back at the nearly 20-year development of China's real estate industry, its real rise began in 2001, after China officially joined the WTO. A massive influx of foreign capital spurred rapid economic growth. With increasing incomes, the desire among ordinary people to improve their housing conditions grew stronger. Additionally, to counter the 1997 Asian financial crisis, the central government intentionally made the real estate industry a pillar to stimulate domestic demand, attracting many capitals and real estate companies to the housing market, especially residential housing. For local governments, the 1994 tax-sharing system reform by the central government reduced the share of tax revenue for local governments, leading to severe financial constraints. Establishing industrial parks to attract investment required coordination and cooperation between the government, capital, and labor, along with significant initial investments in land, funds, factory buildings, equipment, raw materials, and personnel training. The future revenue of enterprises depended on market response and lacked security guarantees. The right and income from land sales were then under the jurisdiction of local governments, a monopoly without competitors. Sales proceeds did not fall under the budget, acting as a personal pocket money fund. offering the most direct, convenient, and reliable source of income. From 2000 to 2022, the average price of land auctions by local governments skyrocketed from 486 yuan per square meter in 2000 to 9,119 yuan per square meter in 2022, an almost 20-fold increase. The cumulative amount of land auction transactions reached 70.8 trillion yuan. Most of this huge sum became the financial income of local governments. Naturally, the pockets and appetites of officials at all levels also swelled with the increase in government fiscal revenue. According to data released by the Ministry of Finance of the central government, the proportion of land finance income in the total fiscal revenue of local governments has skyrocketed from 18% in 2001 to 53% in 2019. Land finance income is revenue directly related to real estate, encompassing 5 types of taxes, which are property tax, urban land use tax, deed tax, cultivated land occupation tax, and land value added tax, which is added on to the total income from land auctions. So, in 2019, over half of the current total fiscal revenue of local governments is derived from land auctions. In other words, the governments and officials at all levels of the Communist Party are the biggest beneficiaries of the land finance policy. However, in the long term, the land finance model is unsustainable. These lands have existed for thousands of years, and their value has always been inherent. The practice of land auctions by various levels of the communist government is merely a rapid monetization of existing resources, not creating new value. Especially after 2008, when the central government released 4 trillion yuan in the name of expanding domestic demand and promoting economic growth. China's economy actually entered the so-called internal cycle of land finance. It no longer depended on foreign trade, manufacturing, technological research and development, or industrial upgrading, which are typical methods of a market economy. Instead, it relied on land sales, development, property speculation, cashing out, and developers fleeing, albeit unconventional methods. Clearly, this was a model controlled by power and counter to marketization, and its adverse effects have been fermenting and causing problems to this day. As the prices of land auctions controlled by local governments continued to soar, real estate companies' already high debt ratios became increasingly burdensome, far exceeding international norms and posing significant financial risks. Comparing with the data from the United States, we can see that China's real estate sector's debt ratio has been significantly higher than the crisis level from the outset, and it has remained between 70 and 80% over the past 20 years, even exceeding the extremely dangerous risk control line of 80% in 2022. These are official statistics released by the Chinese government, which means the financial leverage ratio in China's real estate sector is too high. For example, Evergrande Group and Country Garden, according to the latest financial data disclosed by listed companies, have net asset debt ratios of 137 and 84% respectively. Meanwhile, the average debt ratio of the top 500 companies in the SP 500 in the United States is only 24.7%, and that of companies listed on Nasdaq is 25.3%. The debt ratio of U.S. real estate investment trust equity funds is 33.8%, meaning total debt is less than half of net assets. The National Council of Real Estate Investment Fiduciaries has several key real estate indices. NPI, the National Property Index, has a debt ratio of 44.9%. Core open-end real estate funds requiring low risk set a maximum debt ratio of 35%. But the actual ratio is 23.3%. Value-added closed-end real estate funds tolerate higher risk, with a maximum debt ratio of 66.8%, but the actual ratio is 55.8%. From 2000 to 2020, during the rapid development of China's real estate industry, the standard operational model of acquiring land and rapid expansion, termed "he who owns the land owns the world," adopted by developers like Evergrande and Country Garden, characterized by high debt, high leverage, and high turnover, appeared to be key to their swift rise. However, this was merely another Ponzi scheme played out in communist China. It is important to note that from 2014, investment in real estate development began to decline in China. In response, in 2015, the central government introduced the price increase to reduce inventory policy. This involves lifting purchase restrictions, reducing taxes and fees, lowering down payments, allowing the transfer of housing provident funds across regions. This policy was meant to decrease inventory and stimulate real estate development, thereby stabilizing economic growth. The policy also aimed to improve debt repayment capacity and reduce financial risks. Typically, inventory reduction for general commodities is achieved through price drops and reduced manufacturer profits, leading to decreased production. Government fiscal actions usually involve tax cuts and increased spending during economic downturns. However, the price increase to reduce inventory approach aimed at preserving land finance resulted in inventory not being reduced but merely transferred from developers to buyers, many of whom are speculative buyers or those who are roped into it. It drove up asset prices, masking the squeeze of rising land prices on other sectors and further distorting the economic structure. Data from the charts show that in 2015, the year before the policy was initiated, the square meters of commercial housing sold in China was 1.3 billion. By 2018, it had risen to 1.7 billion square meters. At this point, the market was already saturated, and sales volume had lost its growth momentum. By 2021, the market size hovered around 1.7 billion square meters, stagnating for 4 years. The implementation of the price increase to reduce inventory policy turned China's real estate market into a purely speculative field, drifting away from its original residential property. A common saying in the speculation circles, "A long-held market must fall," reflects the reliance on continually injected capital to sustain transaction growth. Once the transaction volume of commercial housing reached 1.7 billion square meters and stagnated, it indicated the economic limit that Chinese citizens could bear, unsustainable in the long term. Since the transaction volume could not rise, the bubble finally burst in 2022. The transaction volume of commercial housing plummeted to 1.4 billion square meters, a 24% decline. By October 2023, the volume further dropped to 0.9 billion square meters, a 17% decrease. Based on current trends, China's commercial housing transaction volume is expected to return to 2012 levels. In other words, the past decade's frenzy in China's real estate is now just a fleeting memory. According to data from the People's Bank of China, as of October 2023, the total scale of resident debt has reached 79.6 trillion yuan. The primary borrowers of these debts are predominantly urban residents who are part of the adult workforce. Rural residents and retired elderly people almost have no access to loans, resulting in an average debt of about 200,000 yuan per urban adult worker. With a family typically comprising of at least 2 adults, this equates to a debt of 400,000 yuan, roughly the scale of a mortgage of a house. This means that, apart from a few million of the wealthiest members of the Communist Party and bureaucratic elites, Chinese families, after being plundered by the real estate sector, have been left with enormous debts and have hardly been able to accumulate any wealth. However, the story doesn't end here. With the bursting of the speculative bubble, not only did the residents who bought homes accumulate massive household debts, but the operators in real estate development were left with even larger corporate debts. This dire financial situation has extended and impacted upstream capital and investment trusts. Let's look at the data of the real estate operators. Since commercial housing in China was introduced after 2000, previously there was only welfare housing. The sales amount data from the chart comes from the Ministry of Housing and Urban-Rural Development, with completion of pre-sale registration being a prerequisite for banks to issue mortgage loans, which is relatively accurate. We estimate the comprehensive tax burden of real estate companies to be 15% of sales revenue, which is around the industry norm. The actual development investment funds are reported by each real estate company and summarized by the statistics department, including actual cash expenditures for land acquisition, construction, and management. This data should also be relatively accurate. With these three sets of data, we can calculate the net cash flow of real estate enterprises. In other words, sales revenue minus tax burden minus actual development investment. The displayed data reveals a very interesting and ironic phenomenon. Real estate companies' net cash flow in China has always been negative, never positive. This means that China's real estate industry has never extracted profits. Developers, perhaps compelled by the government, reinvested every penny earned back into the cycle of land acquisition and development. Even the reinvestment of profits was far from sufficient, requiring massive borrowing to further push the operating leverage to its limits. Consequently, the actual development investment each year far exceeded sales revenue. The difference could only be filled by borrowing. Since 2022, with the bursting of the real estate market bubble in China, it's impossible for developers to achieve positive net cash flow in the short term. In 2022, it was still minus 3.56 trillion yuan. And by October 2023, despite developers reducing operating expenses and land investment, it remained at minus 2.47 trillion yuan. The annual figure is expected to stay around minus 3 trillion yuan, roughly returning to 2011 levels. In other words, achieving positive net cash flow within 5 years is nearly impossible. From 2000 to the present, the continuous debt-driven operation of real estate developers in China has accumulated a total debt of 67.4 trillion yuan. The final outcome they achieved is 82.29 billion square meters of under-construction projects, essentially the entire assets of the developers. Over the past decade, all land transfer contracts stipulated conditions to start construction within 3 to 6 months. Even if developers intended to hoard land, they would complete declaration procedures on a false form and invest a small amount of machinery for land testing to meet the commencement conditions. According to statistical rules, these plots are included in the under construction statistics even if idle, and even if construction stops. We can estimate the value of these 82.29 billion square meters of under construction projects to see if it is sufficient to cover the developer's 67.4 trillion yuan debt. These under construction projects require an investment in construction and installation costs to ultimately become housing. Assuming these projects are, on average, 50% complete, which is an optimistic assumption, and using the national average price of 4,000 yuan per square meter, the cost will be 16.46 trillion yuan for 82.29 billion square meters times 4,000 yuan times 50%. This is a rigid investment, essential funding without which these projects cannot be completed. Assuming all these under construction projects belong to property developers and are 100% saleable, which in reality a significant portion has already been pre-sold and cannot be resold, we optimistically estimate their value based on the national real estate market's average price of 10,000 yuan. Assuming developers clear their inventory at 85% of the market price, or 8,500 yuan per square meter, the value is 69.95 trillion yuan for 82.29 billion square meters. Also, assuming the government grants a 50% tax reduction, reducing the average tax burden of developers to 7.5%, an utterly unrealistic assumption but used for the most optimistic estimate, the tax would be 5.25 trillion yuan. In total, with an estimated sales revenue of 69.95 trillion yuan minus 16.46 trillion yuan in construction costs and 5.25 trillion yuan in taxes, the net revenue is 48.24 trillion yuan. However, the total debt of property developers to date is 67.42 trillion yuan. Even under the most ideal conditions, the developer's inventory can only support a net revenue of 48 trillion, far from covering the current total debt of 67 trillion yuan. The entire real estate industry in China is, in fact, insolvent, meaning it is essentially bankrupt. Even the self-declared omnipotent Communist Party, with its continuous plundering and exploitation, cannot change this reality. Therefore, whatever measures it takes, it is probably too late to reverse the situation. This is the true state of China's real estate industry. The recent issuance of the Guoqiang opinions on planning and construction of affordable housing by the Chinese government marks the official end of the unsustainable and market-divergent model of land finance. After Xi Jinping came to power, the adoption of extreme policies reminiscent of the Mao era, especially the severe lockdowns during the 3 years of the pandemic and the comprehensive tensions and direct confrontations with Western countries led by the US, has drastically worsened the social environment and severely regressed the overall economy, with people becoming increasingly frugal. Additionally, rapid aging and a sharp decline in the labor force bring serious consequences. As a once pillar industry driving China's economy, the real estate sector is likely left with only one outcome. After eliminating all speculative bubbles, it returns to its natural attribute. In other words, the era of real estate in communist China is officially coming to an end. For private enterprises like Evergrande and Country Garden, which once played a major role in the industry, their ultimate fate is predetermined: either forced bankruptcy and liquidation by the court, reversion to the old path of joint public-private operation under communist control, or gradual disappearance as the commercial and residential markets shrink. The rise and fall of China's real estate industry over 20 years is like a microcosm of communist China's economy. As Derek Scissors, a senior researcher specializing in China's economy at the American Enterprise Institute in Washington, D.C. stated, China is not collapsing. Its very serious economic problems did not emerge this year or last year or in the past 5 years. In 2019, China's economy was 4 years older, 4 years more indebted, and 4 years more entrenched in bad policy than it was in 2015. Repeat for 2023 and 2019. There was no crisis then. There isn't one today. There's only failure of China's economic decision-making and of many people claiming to understand those decisions for the past 20 years.